think some of the topics I'm going to touch on have also been mentioned in the last couple of presentations. But what I'm going to, I think, try and run through is a little bit of a macro scene set in terms of how we're thinking of the backdrop for really ferrous markets in general, and obviously particularly the iron ore market. Then hone in on how we feel current market dynamics are from both a sort of financial and clearly, more importantly, a fundamental perspective, and then give our perspective on the sort of medium to long term, appreciating that from a bank's perspective, long term is not going to be quite the same as it is for some of the other people in the room. Just, I think for background, when we look at commodities as a whole this year, and of course ferrous markets in particular, it's important to consider what happened from a global growth perspective last year so that we can set our expectations for what we think the macro environment is going to be like in 2024. I think the really surprising thing last year is that actually, given the synchronous tightening of interest rates that we saw across pretty much all of the major developed markets and a number of emerging markets, you didn't actually have a material slowdown in global growth. Global growth, about 2.7%, is very consistent with its medium-term trend. If you look at the divergence, though, within that, both regionally and sectorally, it gives us, I think, some quite important indications on what we should expect coming into this year. The key point there is that although we saw resilient global growth last year, that was very heavily driven by the service sector. Global industrial production didn't have a meaningful contraction. So if you look at the chart on the left, for example, after the GFC, if you take this back through to sort of 1950s, you can see other periods where global industrial production goes above trend, and then it has a bit of a bust. We've gone above trend in that boom that you had during COVID, but since then we haven't had a bust. You've effectively had a period of about 18 months where global industrial production growth went sideways. So demand growth was weak, but we didn't have any meaningful contraction in the overall global industrial sector. That does leave a bit of risk, and it also, I think, from an inflation perspective, shows that you haven't put that much slack back into the system from a broader macroeconomic perspective. And I think as we're experiencing, obviously, early this year, it underlines that there is a meaningful risk that if growth stays robust, we find it even harder to complete the task of achieving a normalization and stabilization in inflation. But thinking about this year, we are seeing global goods demand start to improve again. And that should mean that we get a pickup in global industrial production, which will be beneficial for industrial commodities as a whole, very much including the ferrous sector. And also, to this chart on the right, what I'm trying to illustrate here is that if you look at the sub-indicators of purchasing manager surveys, what they've shown is that we've gone through a period, particularly in Europe, but I would say more broadly across developed markets, of destocking. Implicitly, if you're seeing the quantity of purchases less stocks of inventories go negative, what it's telling you is that companies are destocking, and I think that's been observable in a number of physical markets over the course of the last year or so. The upside from this is that if global industrial activity is resilient, in addition to that, we should get a better first-use demand pull on industrial metals, including steel, globally, from a restocking cycle that we would expect to come through in the second half of this year. And arguably, a lot of the other industrial metals have already been reflecting that, potentially to too great a degree, though that's another debate, but they are showing signs of at least anticipation of better industrial production leading to a pull-through on demand. And of course, copper is the poster child, but actually if you look at the performance of a number of the other industrial metals, even for example zinc, it would tell you that's there. And yet iron ore, of course, has had a pretty weak start to 2024. So let's try and dig into why that's happened. I think the most obvious driver from a fundamental perspective, if you look at the left-hand side chart here, is the sort of 40-odd million tonne from the lows of last year build that we've seen in port stocks. I think that is the indicator that most people have been understandably pointing to as a reflection of a market which has moved into physical surplus. Excuse me. In addition to that, when prices were on the lows, and I apologise from an SGX perspective using DCE here, I look forward to the Commitment of Traders report being released, but at the moment a smooth open interest series is easier to track. Although open interest never got that high, you quite clearly saw a period in the early part of the year where there was a build in open interest as price came off. We did see speculative shorts in the market. However, when we think about what was going on sort of underneath the hood of that build in port stocks, I think there were very good reasons to believe that the sell-off and the brief period below $100 per tonne was unsustainable. The reason I say that is, I think, twofold, both from a supply and from a demand perspective. But also, when we think about why it was unsustainable, it gives us some reasons to form slightly different expectations around, say, the back half of the year and into 2025. The first point, that build in port stocks was partly just a function of relatively good supply. You can see that into the end of 2023, and then obviously arriving in early 2024, aggregate shipments out of Australia and Brazil were very healthy, and 2024 year to date is still positive year on year. However, one of the things that I think told us this was unsustainable is how sensitive you can see, if you look at the chart on the right, Indian exports of iron ore were. And that material, in our view, is still needed in the market at the moment. So as you saw that coming out in response to a price decline, it did suggest that the potential was there, if prices didn't rebound, for the market to start to tighten. That didn't tell us you had to have quite such a fast and large rebound in price, but I think it did suggest that it was unlikely that, as of yet, prices sort of below 105 were sustainable. The other point is that clearly one of the major contributions to that build in port stocks is that iron ore consumption has been a bit soft. And by that, evidently, what I really mean is pig iron production. But if you look at the chart on the left here, comparing pig iron production to current flat steel output, it suggests that pig iron production has been running too low. So a lot of people have been talking about, well, seasonality should mean it increases, and of course there's a natural seasonal pattern. It's been lagging that seasonal pattern. I think the thing that gives us a bit more confidence in the expectation that it should increase, and we've seen a little bit of that in the last sort of 3 weeks or so as prices have improved, is that it's unsustainably low versus current levels of steel production. So that implicitly people have been destocking semis. The issue, of course, if we think further out, and I'm going to come to this, is, well, do we think current levels of steel production are sustainable? But in the short term, I would highlight, one, that chart on the right. Mills inventories can go lower, but are already relatively low. So into a price dip, their scope to destock further is relatively constrained. Second, if we look at mills margins, and I'll talk again in a moment about sort of some of the structural issues around mills margins, but they did improve into that price dip. And again, I think that gave us confidence that you were likely to see some improvement in first use buying from consumers. And then really third, flat steel apparent consumption is actually healthy, so that the scope for an immediate cut in flat steel production looked relatively unlikely if you're considering, one, that margins were improving, and two, that demand is actually quite good. So I think that set us up for the potential to have the rebound in price that we've had. However, if we think about the fact that mills margins have already deteriorated again, and we then look at the fact that although flat steel apparent consumption is good, and of course it's dipped in the last couple of weeks on seasonality around the May holiday, the level of flat steel inventory is a big red flag about the sustainability of that flat steel production as we move through the rest of the year, and whether we're going to see an environment where that starts to be cut. The glass half full argument would be, given the macro points I made at the start, we see global industrial production improve. Of course, that's partly a China dynamic, and that would be direct first-use consumption. That's also Chinese goods exports, things we mentioned earlier in terms of the automotive sector. So you have that first use in China feeding end use in the rest of the world, and also that you just have better flat steel consumption globally, which can sustain Chinese level of steel exports. However, it's important to stress that that apparent consumption number that you can estimate on a weekly basis is not domestic consumption, it's total, and so it's including exports. And if we put together the level of inventory that you're now seeing and the level of exports, the safety valve of exports is really, really very important here. If we see any decline in the run rate of exports, and coming into this year, we thought you'd have a little bit more of a headwind for steel production, partly because we thought exports would at the start of the year probably be up year over year, but then as you have a higher base effect, be down year over year in the second half. But currently they're annualizing at sort of best part of 100 million tonnes. And while that is supportive of steel production and of course of iron ore demand, again, I think it's quite a big warning that if you lose some of that safety valve that's sustaining steel production and you see a further build, or rather further failure to draw at a seasonally normal pace on flat steel inventory, you're again raising that prospect that HRC prices will be under pressure, mills margins will go back to some of the levels that we saw at times last year, and that then steel production cuts, and of course iron ore price weakness would become a much more pertinent problem. Just to sort of deviate slightly to the long steel side, I think somewhat ironically, given the understandable bearishness on long steel because of the challenges facing the construction sector, it's worth highlighting that long steel production has arguably fallen sufficiently far to account for that, if not too far. So that there is some irony in the fact that flat steel demand is actually very good, long steel demand is frankly pretty awful, but it's flat steel inventory that is the overhang, that flat steel production is arguably too high for a good level of demand, long steel production is actually arguably too low. Does this mean that you could get a pickup in long steel production and that could provide an offset to any potential weakness that comes through in flats as we move through the course of the year? I mean, the key part here is clearly going to be the property sector. But I would highlight, given a large portion of that long steel cut has come from the EAF side of the market, not from integrated producers, if you do get an improvement in long steel production, of course it will be net beneficial for iron ore, but it will be less beneficial, in our view, because part of that would be met by a pickup in utilisation rates from EAFs. In terms of property, we do actually think you're getting to a point where, in sequential terms, year on year will still be down this year, but in sequential terms, net of the normal seasonal pattern, we should be seeing a bottom in long steel demand from construction activity. And I say that because if you look at the guts of the data on the sales side, there are some things that are reasonably encouraging in terms of the relatively healthy sales you're now seeing of already completed projects. If you look at sales of second-hand homes, you're getting to a level where I think sales are sustainable. And also, if you look at the demographics around, for example, household formation, it's consistent with the idea that sales, of course, can cycle from here, but demographically, they shouldn't have another leg down in the near term. And in that context, starts have undershot. Starts mapped onto construction steel demand, of course, is very imperfect. There's a lot of challenges with the starts data, but actually that we do think you're getting to the point where the market should be bottoming. We're not, though, expecting a rapid increase, and I would also stress, if we try and think about the way the property data is reported versus actual consumption of raw materials from the sector, the weakness in completions that we do think will come in 2025 is going to be a bit of an offset to that, so that we think the market should be bottoming, but not that you should be getting any rapid acceleration. So I think to hope for long steel to provide a meaningful offset if we get some weakness in flat steel is probably a bit too optimistic. The area we are, of course, seeing a lot of strength is on the infrastructure side. And you can actually see, if you look at the chart on the right here, in terms of fixed asset investment growth, the private sector, partly because it was dragged down by construction activity, effectively contributed nothing to fixed asset investment growth in 2023. All of that growth was from the public sector. So we are getting a form of stimulus, and that's been mentioned in earlier presentations, but it's not one that is going into the property sector. And in our view, it's very unlikely that you will get a big traditional, in sort of inverted commas, bazooka stimulus focused at the property sector, largely because of this chart on the left. It's a bit noisy, but if you aggregate up observable stock of debt to GDP, you're talking about 300% now. If you want to try and juice up the property sector and go back to anything like the levels of construction experienced at times in the past decade, you're almost by necessity, given demographics, going to be bringing back investment demand. And investment demand into lower tier cities which don't have net demographic growth would quite clearly be a misallocation of capital. So it would be cyclically positive, but structurally something you really don't want to do. So our expectation is that this will be avoided. And also actually when you look at GDP growth, how it's evolving this year, it's not needed to hit the GDP target, particularly while inflation is so low or even negative, that it makes it relatively easier to hit a real GDP target. We do, though, expect strength in infrastructure to continue, and this to be one of the key thematic drivers of industrial commodities demand over the next few years. There is, though, I think, an important distinction to make between what this means compared to a commodity supercycle. There's been a lot of labeling of what's going on from an energy transition perspective as something that could give us another commodities supercycle. If you look at where we think this is really going to play out on the build-out of renewables, as well as, of course, EVs, China playing the biggest role in that initially, but I think more importantly, on a structural basis, actually, the Western world having to start to contribute and really sort of pull its weight in terms of commodities demand as we move through the back end of this decade and into the 2030s. But it's differentiating. It's not like the surge you got from China's urbanization and industrialization that provided a rising tide to lift all ships with a multi-year period of above-trend demand growth. That's not what we're talking about. We're talking about something which should be very differentiating. Of course, what that means from a price perspective is also then dependent upon supply. There are some commodities on that list which have phenomenal demand backdrops but have overwhelming supply. Some of the lower end of that list, and I'm going to talk about iron ore a bit now in a medium term, that has relatively low seaborne demand trend growth, in our view, still positive. And so actually whether the market can stay reasonably balanced or tip into a period of oversupply is going to be, of surplus, it's going to be heavily dependent on supply. In terms of that trend demand growth, we saw a couple of comments earlier about long-term or medium-term expectations for steel production. Our view when we just think about not trying to forecast the next couple of years, but what is the structural setup for Chinese steel production, is that current levels are broadly sustainable, but that you will cycle around them. And the reason we say that is really driven quite heavily by this chart on the left and also what it implies for steel stock. What this chart on the left is showing is the amount of steel consumed per capita versus real GDP per capita. So rather than having time, we're showing it in terms of the development of the economy in GDP per capita. China's at about 700 kilos already reached developed market levels of steel consumption per capita. But it's done it so quickly that the installed level of steel stock in the economy is nowhere near developed market levels yet. And so to us that suggests that you can sustain current levels of steel consumption for some time. But to grow from here, especially given the only country that's ever really got materially above this level was Korea, and that's flattered by exports of steel consuming goods. And China's economy, albeit very strong from an export perspective, is so large, the rest of the world just couldn't digest the equivalent trade balance. It's very hard to see why you have any structural growth left. We're not talking about a collapse, but I think we're talking about an environment in which it's broadly sideways with a bit of a cycle, and within that, as scrap, which is almost a perennial disappointment, just chisels away in terms of market share, you see a slight decline of around about 0.5 to 1% CAGR for pig iron production. The offset to this is India. And I mean, for pretty much my entire working life, I've been asked about, is China going to be the next India for commodities consumption? And quite clearly the answer has been no. But we are getting to the point where the absolute scale of the ferrous market in India is sufficiently large that with healthy CAGRs, it can become one of, if not the major driver of marginal demand change. And so that when we look at global crude steel production expectations out through our sort of 5-year forecast period, we think India actually towards the back end will be around 50% of global steel production growth. We're therefore assuming not that you can grow at the kind of CAGRs that China achieved or India has briefly achieved in the past, but that demand can grow around sort of 7.5%, 8%, maybe a little bit higher. I think to get to the 300 million target that the government has indicated by the end of the decade, which would be kind of getting up almost towards the teens, is a big ask. And in our view, while it's theoretically possible, it's very hard to see how that would be driven by domestic demand. So that if you were achieving that, India would be becoming a bigger net steel exporter again. And so from an iron ore demand perspective, you'd be having to substitute that away from somewhere else in your balance. To sort of finish up and conclude before any questions, the problem you have then is that trend demand growth, while not negative, is going to be low unless we find some currently, I think, unforeseen element to really pick up the baton for steel consumption. And we are, after a period of relatively limited supply growth, facing a multi-year period where supply growth actually is going to pick up quite heavily. The elephant in the room on this, of course, is Simandou and the pace at which that comes to market. Got our assumptions here that you're getting up to sort of 90 million tonnes by the back end of our forecast period. And the way that we then forecast price is to say, well, it has to trend away from a sort of long-term sustainable level. But in reality, that's not what would happen. And that's not what we would expect to happen, but you can't realistically with any accuracy try and forecast a steel cycle 3, 4, 5 years forward. But if you think about how other markets have behaved during periods where they've tended into oversupply, although the supply is what sets the scene for potential price weakness, it's not generally what drives it. When supply is the dominant driver of market pricing is generally when you get a true supply shock, of course, normally a negative supply shock. But then actually, if you think about what's happened in the iron ore market in the past, going back to 2014, 2015, think about how other commodities have behaved, also thinking about crude oil, for example, in that period as it faced the ramp up of shale production in the US. The oversupply creates the potential for price weakness, but when you generally get it is when you get a downturn in demand. So that our view would be, for the back half of this year, yeah, you probably have a market that softens up a bit, but actually given our view on global macro, it's unlikely that the market goes particularly oversupplied or trades to particularly weak numbers within 2024. But when we look a bit to 25, but really that 26, 27 window, whenever you get any slowdown in the global steel production because of a weakening aggregate demand backdrop, the market is likely to then really feel very sloppy. And the way that that results from a pricing perspective is not that you go to a sort of long-term sustainable equilibrium and just trade there, which in our view is probably sort of $80 real, maybe, depending on cost inflation, could push a little bit above that, but that you properly crash into the cost curve and you do some damage. And then the market, of course, rebounds above a sustainable level because you've cleaned things up from a supply-demand perspective. So that our view is that as we look at that sort of 5-year window, there is quite clearly a considerable risk that at some point the market really does trade down to at least, I think, with a 7 on the front, quite possibly a 6, as a process of rebalancing, because it's going to be very hard to absorb the amount of supply that is currently projected to come on. Unless, of course, as we've experienced in many commodities over time, we do find something really disappoints on the supply side and slows that down. But that's it for me for my slides. Thank you very much.
Hello. Hello. Yes. Sorry, Marcus. You just please hold on for a while. So we have 2 questions from the audience now. So the first question is, what's the greatest risk to the base case market outlook this year?
I think, well, always plenty of risks. Probably the most obvious one, given the dependence that you've got on flat steel production for iron ore consumption at the moment, is that view that we're going to see better in global industrial production, and of course within that relatively strong Chinese industrial production manufacturing activity as we move into the second half. If actually we find that you finally see a bit of a catch down on goods consumption from the lagged impact of, for example, interest rate policy tightening, then you could see that weakness becomes much more prominent much earlier than we're currently expecting.
Okay, and the second question is, how do you view decarbonization efforts impacting the overall market outlook?
Well, I mean, people who are much more knowledgeable than myself on this already commented on that in the earlier presentations. I think For us, it's not something that changes the overall balance, and it's not something that changes how we view sort of index price, but it is evidently a differentiator. And I mean, we actually, and I think, presented some analysis that our colleagues in London had done on this same event last year, have a very similar view about effectively what's going on the DRI side, almost presenting an unsolvable balance for that part of the market as we look at the back end of this decade. So you should have some pockets of really quite extreme tightness, but it's not something that we would expect to set the price for the balance as a whole.
Right, okay. Yeah, okay, so ladies and gentlemen, Mr. Marcus Garvey, so a round of applause, please.